All right, so the markets are kind of in this stalemate of breakout from last week that appeared to be breaking through some really significant levels, not by a lot, but by enough to still be above them today, but also with this debt ceiling issue. And so, in between these two kind of major things, we ended up having about as flat as the day as you could possibly have on the S&P 500 at least. With very, very little volume, very small range, all with eyes towards what's going on tonight, right, with the scheduled meeting between the Speaker of the House and the President regarding the debt ceiling and its resolution. So again, we might be getting a resolution that might be able to really break through. But there are some red flags about this bullishness. And I'm going to show you what those are. Most of you probably know them by now, but we'll reiterate what those are. And then we'll talk about if this breakout does continue, what will be the leaders that will lead us up to higher, and how much longer will we go, and how will that impact the FOMC and their rate policy. With that, with our long-term return expectations now a deal. So we'll talk about that as well as our trade idea stock that we've had some success trading in a sideways pattern, considering the neutral markets in most areas beyond the high-tech mega cap names. So we'll take a look at it and see if it's a good option to do it again. So let's go ahead and get started. Today is Monday, May the 22nd, 2023. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon here, the red subscribe button down there. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live video. Come down here to the bottom, click this heart. It opens up this tab. Hit that like button there, or you can click on this thumbs up icon as well. Once you get back to this, click on that thumbs up icon. It takes you to this tab where you can click on that like button there as well. There we go. So click that like button there. Again, the more you do that, it helps get our content out to all of our followers on those platforms. Our goal is always to get over 100 on the likes. That helps with the engagements. It's a big deal for us, so that's why we always ask. So thank you for those who do like us day in and day out there. For those who don't, you can do it right now while you're watching with one or two really easy clicks. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we had a flat day today. It was up. It was up by 2/3 of 1 point. So very, very small range, 0.02%. Kind of finishing underneath, you can see this 23% retracement level actually goes back to the post-COVID rally. So we'd be getting back above a really important line. As we have here in the last couple of days, gotten above a couple really. I mean, these three are all narrative changing lines, that we are no longer correcting the post-COVID rally anymore. We are now on a bullish impulse move, with bullish impulse moves to the upside, breaking through that 78% retracement, and then breaking about into the upper half of the correction, crossing the 50% retracement of the entire correction. So very, very big moves that we're holding on to. We're not really breaking through. 41.98 is where that line happens to be, right? 4,200 plus or minus a little bit. And we're still just a few points below that. So we're not really busting through, but as of right now, holding above the February 2nd high point, where we closed at 41.79. That's our highest peak that we've had. So that's a good sign since August, right? That's a good sign for the market. The intermediate line's rising back. It never did decline to bearish territory, so we've been on the bullish run this entire time since right around the end of March. Really wasn't that big of an intermediate decline to begin with, but we've been on a rally this entire time. For comparison's sake, the Russell 2000 has just barely started. So we've been since the end of March 30th, on an intermediate increase. The Russell 2000 has just starting its intermediate rise, with the intermediate line getting into bullish territory here and getting above the moving average. We're not very far. We're only about percent. That was about how far above we got over here on these bear tags. We weren't able to really get going. So the long-term market sentiment's rising, still at low levels. Let's go back to SPX. Its short-term sentiment's declining. In fact, you could say that this is an intermediate confirmation signal, the combination of a strong bullish posture with the intermediate line most likely rising above 80 tomorrow, and an oversold momentum line. It'd be better if the near-term line was down in bearish territory, but this is our third time we've had this bullish, this kind of an oversold momentum line. The last two were extremes, and neither time did it bring the near-term line down like these first two times did. So an opportunity for this to really rally through, especially if we get a debt ceiling deal tonight, more than likely, considering how the markets have reacted to the news on the debt ceiling, you would expect at least an initial surge. Whether that ends up being a fake out kind of knee-jerk move or not, you would expect at least a knee-jerk to the headlines, right, with the debt dealing compromise, and that would get us up. You can see we're not above the 2.5% mark, above the 30-day moving average. So we're not that bullish, but we are setting up for a short-term bullish bounce with the kind of pattern that we're seeing there. The Dow Jones remains the most bearish. It's actually in a bearish posture now. Dark pink shading in a red line. We're only 1% below the moving average, so we're not that strongly bearish. The intermediate line is falling in bearish territory, though market sentiment line is rising still into bullish territory. So a little difference there. And now the question is how long this little dip will last. The short-term sentiment rally that we had at the end of last week appears to be failing. The near-term line dropping. I did get up to a pretty decently bullish level, but only staying there for a day or two is not bullish. So a pretty bearish near-term peak. When you look at that perspective, the last near-term peak was a slightly lower near-term peak than the last one. And then finally, your NASDAQ 100, which has been the most bullish pattern as it went parabolic at the end of last week. And the short term, is still at these higher levels, is crossing above its August peak, forming another 52-week high today. Intermediate lines not only in the upper reversal zone, but it's above the 90th percentile. Market sentiment lines back in the upper reversal zone. And again, you're getting that same intermediate confirmation signal with an oversold momentum line. Though it would be better signal if the near-term line was in bearish territory. It's actually still, in fact, you kind of have a cluster here. It's just not the three typical lines that produces the dot, because that would be the momentum line. It happens to be the market sentiment line. So you're that close to being pretty darn overbought. Or again on the NASDAQ 100 with that breakout to 52-week high move that we got at the end of last week. Now let's take a look at some of these other charts, other technical charts that we take a look at generally. You can see this week, so again, we're only a day into it, but last week we got a kind of a bullish breakout week with that candle closing after a couple transition candles, closing back above this body where we got the lower close. We finally got back above that body, so that resumes the bullish trend instead of reversing it. And obviously a much higher close this week so far, though we're not getting a higher high, but at least we're getting a higher close. You can see the candle, the size of the bullish candle is above its moving average, 3-day moving average, 3-week moving average. Though it's not very high, it's still at pretty low levels, relatively speaking, when you're looking at how long we can get a trend going here. Especially considering we're at such low levels. It's one thing to be this low when your PPO is at 8%. It's another when we're only at 2% and we're just kind of starting on this run that we're having. Let's take a look at the 3 green arrow charts. We have 3 green arrows for all of them except the Dow, right? The S&P now we're looking at 4 days of 3 green arrows. The NASDAQ from way more than that, 2 weeks. And then you got the same 4 days of 3 green arrows on the Russell 2000 as well. Of course, your Dow Jones has had 3 red arrows more recently and now has 2 with the stochastics showing a red arrow and the MACD pretty flat there. So, but getting multiple days in a row of green arrows is a good sign for the markets. You can see from when you look at the moving averages, you were well above the 8-day, 17-day. They're both above the rising 30, which is also above the rising 50, easily above rising 50. MACD is strong, above its moving average. Stochastics is moving into. A lot of that's due to the Qs. You can see the Qs are also showing very strong levels. All these lines rising on top of each other in right order. Stochastics at very strong levels, 94th percentile. And then MACD at relatively high itself, the strong momentum. On the other hand, your diamonds, which tracks the Dow Jones, you're back below the 17-day moving average. The MACD is flirting, or actually is slightly below its moving average, and it is negative and falling. Your stochastics is still in bearish levels. So after getting one day last Thursday above the 17, getting back below both and filling in the gap between the 30 and the 50 today. So now the question is whether we're able to get above the point of control. The Dow's the only index that's below its point of control. The Russell 2000 now having crossed up above it and above its moving averages. You can see the 8-day and 17-day also crossing above the 30-day moving average today. So a good sign for the Russell as its MACD has turned positive and the stochastics reaching into bullish levels as well. Now let's take a look at some of these other oscillators that we have, like the DMI for an example. You can see very, very low negative index. The last time it was this low was in August of last year, but at the time that we were this low, the positive indicator was a lot higher. So in fact, it was approaching 40, not being below 30. So that's a little interesting difference there. Of course, you still have pretty neutral lines there on the diamonds, and the Qs are just strongly bullish. The ADX is now rising well above 25. It's also its negative indicator is low, down to below the 11th percentile. Again, close to that same August peak, and it's again same level of the positive indicator that it had back then, though it is the lowest peak so far on the positive indicator that we've had since this bullishness started at the beginning of the year on the Qs. Let's take a look at some other oscillators. Look at the RSI and the CCI. There we are on the S&P. We're still kind of in bullish territory. The CCI did get above 150. You're still above 60. So you're in bullish levels. Not really the strongest RSI levels there. Of course, your NASDAQ is above 71. The last time it got above 70 was on February 2nd, the exhaustion gap. Before that, so even in August, it didn't get above 70. So we did get above positive 200 as well. There's a couple of other times we've gotten above 200. It was also an exhaustion gap, as well as this move higher in early December. Those are the other two times. So we've had both of those now on the same level. So it kind of goes to show again just how strong the move has been on the NASDAQ, and in the past has proven to be relatively bearish for the index. Of course, when you look at the Dow Jones on the other side of things, you're below 50, so you're in bearish levels, though you haven't broken below 40 yet, and you're also below zero again, though you haven't really broken below that minus 150 level aside from this little quick drop that you had in early May. Let's take a look at the whole moving average. I want to take a look at the whole. So there's your whole, some pretty strong candles there. You had a pretty strong move as well. You're above the PPO and you're looking really good. Again, the diamonds, not so much. The parabolics are still on top of us. The PPO is still negative. We're barely positive. We have a negative Hakunashi candle now. So you see the difference there, and you look really good on the S&P in terms of where we are relative to the 4-week range. The Dow Jones Industrial Average actually still below its moving average. The Russell had been below, and finally it really kind of broke out there. And your NASDAQ has been so strong that the average is above in the 80th percentile still. It never really dropped at all here during this late April, right around this April, early May, late April, slight pullback. So very, very strong levels there. Finally looking at the, we're looking at the Ichimoku cloud. We didn't look at that one yet. You are almost to weak bullish levels, so you're almost to 1, you're almost to 50. That starts a weak bullish trend. Of course, it's not the case for the Qs. The Qs are actually well up, in an intermediate trend strength, very high rate of change over the last 26 days. When you look at the rate of change here, and let's change this to the 26 days to kind of get a sense of just how bullish the NASDAQ is. The S&P, you can see, is only 1.3%, but the NASDAQ is up at almost 6%, was at one point almost 8% on last Thursday. So that's where that rate of change, this is what this is showing, that gap here on the rate of change, relatively high, and again, intermediate trend strength. Of course, your diamonds don't have any kind of trend going at all. You are positive on the trend quality, though you're not above 50, so that's positive. You're still above the cloud, but you do have a negative rate of change on the Dow, and you can see the noise balance is below 50. So still maintaining a pretty significant difference there. Looking at the S&P, we did get above the upper Bollinger Band last Thursday, a nice little breakout type move. And so far, we're still in the upper quartile. We don't necessarily need to break out to continue to stay above 100, though you do like to see the moving average, these Bollinger Bands, get outside the Keltner channels. So the longer we stay in the upper quartile, the more probable that is. See, we had that over here as well in the end of April, right there, and we weren't able to continue to stay above as we rolled back down. So that's something to keep an eye on. Of course, the Qs have been well outside the Bollinger Bands for multiple instances, and well outside the Keltner channels right now. Some strong momentum down there in green arrows. That's your Qs. Your diamonds, on the other hand, are in the lower half of the chart, floating with the lowest quartile. You're below that point of control, as I mentioned before, and the bands have been inside the Keltners for a while. So continuing to get a pretty significant difference here between the Dow Jones Industrial Average performance, which is still weak, versus the NASDAQ 100, which is 50% made up of 7 companies. The other 50 made up of the other 93 companies. So very small weightings in that half, very big weightings in this first half. So you're still pretty much dominated by those stocks, as you'll see here in just a second. All right, now let's take a look at today's range. Very, very small. It was actually an inside day, and that was a really small range yesterday, or Friday, excuse me. So really, really small range. We did not get a new high today, but we are obviously a lot closer to the 4-week high. So we still have this nice, good bullish run. I can get rid of this blue line now since we got the breakout of the bullish side. Of course, to have a reversal to the downside, you need to get the red line to hit 0 and the green line to get below 70. And that's going to be, now that we're down one day, it would take 5 more days. So that would be into next week before that happened. That's not the same with the diamonds. The diamonds are actually closer to the lower half, the lower bound of its 4-week range than the upper, in the lower half of the chart below the point of control. You can see continues to have still waiting for which one of these will break out, and looking for a breakout of a really, really tight bandwidth. The Russell 2000 got that breakout yesterday. Today we got the high. We also got it yesterday, or Friday, but we got the high again today on the Russell. So that's the first time that we've had this, the green line up to 100 in a long, long time, right? The last time was the February 2nd gap, and since then we haven't had a new high, and it's been now over 3.5 months in between new highs. So good mark there, and again, we're considering today we got a new high. You're 6 days away from any potential bearish reversal. So those are looking like pretty good signs. So like I said, today's range in volume was really light. The volume at 60 million shares, you can see what that looks like relative to prior days. Here we go, right there. And then the range up there at 3 points, well below the average, and that's a really low average. It's well below 1%. The volume at 60 million. These are really, really low numbers. Here we go, right here. 60 million's way at the bottom of the chart, so it's extreme in that direction. And then, of course, your ATR is at its lowest levels of the past year, and we're well below that. So, and we're approaching the 1% mark on the ATR, which getting below that kind of really solidifies the trend that we're on right there. The VIX is also kind of a measure of volatility, of course. Always kind of ramps up on Mondays because that's the way it works. It finishes at the lows and then gaps up on Mondays. But you notice down here, you're still right around this 85% mark, so not really a significant move. The correlation with the VVIX is still really low. So the VIX is down, barely above 17, but the VVIX is still relatively elevated. A couple days, even though we've been so sideways the last couple days, we've had a couple days of rallies on the VVIX. So the VVIX is suggesting that there's some implied volatility of the VIX coming forward, which of course when the VIX gets volatile, it tends to move higher, especially if the correlation renews its near 100% levels, which it normally gets to. So again, we are still at levels that have preceded moves higher in volatility that we haven't seen that move higher yet, and we're still not below zero, but we are still below 50%, which is still a relatively weak sign. And you notice we have had weak correlation there with the VVIX for most of this past year. When you look at so from perspective on this, that's not normal. It tends to be very short-lived and bounces back up, and definitely in 2021 and the early part of 2022, when we were on the rise, it stayed pretty correlated. And like I said, every time we pulled back on that correlation, that's led to a pretty decent, as the correlation got back up to high levels, the VIX rose as well. And so again, that's the expectation here going forward, is the VIX rising, which would suggest that we might not get into a period of breakout and slow, gradual moves higher if volatility does follow that same pattern over the next month or two. All right, when we take a look at what's driving this market, again, you can see the Qs, the 3-month returns are still very abnormally high. The IWM is still actually negative over the past 3 months. So are commodities and real estate. So these have been a risk-on asset classes recently. Real estate is not generally, but has been kind of correlated with equities lately. Of course, the Qs are just blowing them away. Gold and bonds have been higher. EFA has been higher. They're still holding up. The bonds have really been dropping. If you look at just today alone, let's move out to May 22nd. You can see small cap stocks had the biggest gains. So they've been so depressed, but they're kind of starting a little bit of a bullish run. It's not kind of moving over to the Dow, unfortunately, but at least small caps are starting to pick it up a little bit, maybe catching up to where the Nasdaq has been leading here. That's that has helped the ratio chart of the Nasdaq relative to IWM come down from what was really high levels last week. We closed last week above 1.91 after a closing of 1.9 for the first time in over a year. We closed at 1.91. This is really, really high levels that we saw back at the end of October. Again, that led to the reopening trade when the election came out and we had the vaccine. We had the big move higher in value stocks that were beaten up the most during the shutdown. It's not typical for the markets to be bullish when this ratio comes down, as you can see throughout most of 2022 going into the beginning of the year. We've been so parabolic, and we're looking at some weakness right now in the long-term PPO as high as it is and the RSI as high as it's been. Any kind of weakness here wouldn't necessarily be a consistent bullish pattern. It would actually start to be a little bit more bearish there. So we want, if we're going to maintain our bullishness, we want the Qs to maintain their outperformance. And how long that will last, who knows, considering how bullish it already is. But you can see today, the strength and risk appetite push high yield over long-term bonds. Gold is down. The dollar underperformed relative to other asset classes. So it was a relatively decent day. Let's take a look at some of those moves here. Let's go to yields in particular, because you can see bonds are down today. Yields continue to move higher. Whoops. That was the theme of last week. We had such a strong move. Well, we finished the day above 3.7% after almost doing it last Friday, get to 3.69. But at 3.7%, all these moving averages are crossing to the upside. Strong momentum and stochastics to high levels. Again, this has not been a bullish time for equities either to get yields rising. So that's a factor that we have going on. The one, you see how high the 3-month has been. The 1 month, because of this debt crisis issue, rallied 10 basis points today to 5.6%. The overnight rate, remember, is at 5%, 5.25%, excuse me. you're at 5.6% on the 1 month. And of course, the 3 month is your, the 2 month is kind of what the bond market tries to price in, the 2 year, excuse me, where the bond market tries to price in expectations. It did bump up a little bit. It's still at 4.32%, considerably lower than where the Fed funds is. The 3 month, on the other hand, is kind of the current effective rate. And you're at 5.28, so you're above levels. So that kind of coincides with the increasing odds, back up to 20%, and was fluctuating between 20 and 30% today. Increasing odds of a rate hike at this June meeting. Definitely the decreasing odds of a rate cut. Now we are down to, you got a 14% chance, which again, just a week ago you were at a 99.3% chance. So now you have an 86% chance of a rate cut. So the odds of rate cuts are declining, and we were looking at a rate cut as soon as September, and even that's dropped all the way to 24%, where it was at over 60% a week ago, and has been close to 100%. So odds of rate cuts are declining, and that's actually a good thing. What we don't want to see, if the markets are going to be bearish by the end of the year, if the market's going to be bullish, we want to maintain this inverted yield curve for as long as we can, and keep the Fed rate cut odds down to zero. That is our bull case scenario for getting the new highs. QQQs will lead the way higher. Inflation will ramp back up again, so yields will rally. But that's okay, because again, if we're going to get to 4,800, you're going to have positive risk appetite that will be more than enough to overcome that inflation, at least for now. But by the end of the year, of course, that's when it's like, okay, how far up will inflation go back up? Because again, we have before this July meeting, we'll have our June and July releases of the May and June data. They're both expected to be really low to bring the year-over-year rate probably down to 3%, bring that real Fed funds rate up to 2.5% or 2.25%, 2.5% if we get that rate hike in June, which is where the Fed wants to get it and where the Fed wants to keep it. But if the inflation level starts to ramp back up towards 5%, then that means the Fed may start to increase rates by the end of the year. So that's kind of the sweet spot we're trying to navigate, is no rate hikes for as long as we can and no rate cuts at all, because rate cuts again will be coincident with a market that is actually bearish. And so the odds of rate cuts falling and rates rising, especially in the short term, is actually a good sign. Again, we want to stay inverted as long as we can. When you go uninverted, when you go back above zero, it typically goes pretty fast when it goes back above zero, and you can see it's typically during recessions that it does that. Of course, that typically coincides with rate cuts. So we want to stay inverted. We want no rate cuts. That's our bull case scenario, and we'll kind of ride that train until inflation gets back up to levels where they feel like they need to get the real Fed funds rate back up, which, ideally by the July meeting, it will be right at their sweet spot. And that's definitely where they'll pause if they hike rates in June, which I think there's still a legitimate chance that they will, but they will definitely pause at that July meeting, because I think they will be where they want to be by then. Let's take a look at the sector rotation. So you can pull up the sector charts here. And here's the problem with the market. So you can let me look at the 3 month returns. It's pretty much all XLK and XLC. Anything AI related, right, is what's driving this market, and those are the two sectors where AI is a bigger deal. If you look at today alone, remember it was the IWM that was the big mover, but you notice these are all S&P 500 sectors, mind you. But look at staples down, but real estate and communication services were up, Google being a big part of that. But everything else pretty flat to not really moving anywhere. And you have discretionary down, along with materials and energy, which are dollar sensitive, but also economic growth sensitive as well, with industrials lagging behind some of these other areas. So, not as risk on today as we think, though it was relatively muted. One of the biggest problems we have in the market continues to be this lack of breadth. The McClellan oscillator is positive, but it needs to get above 35 for us to feel really good about a trend developing. And obviously we're not there. We're barely positive, and the summation index is actually still negative. When you look at the money flow, you can see that getting back to these levels that we haven't been since August. Actually, if I were to zoom out, let me show you kind of this pattern here. If you were to zoom out, we're actually back to levels that we were at in June of 2021 when we pulled back to this level. You can see where our money flow was then compared to now. You can see where the money flow was when we first touched this, because we're right at this 23% retracement level. When we first touched it, our money flow was right here. Right, that's the first time we pulled back down to that level, so it was a little bit lower than where it was over here when we first touched that line, right in this area. But obviously you can see still higher than where we're at, and when we touched it again, similar levels, again way higher than where we're at now. When we peaked in August this first time, that's where our money flow level was, and again, I mean, a big drop in money flow during the decline in September and early October, and not nearly enough on the rally back up to offset it. And so even though we're back up to similar levels that we were even here on August 25th, we're nowhere near that same level on the money flow. So a lack of money flow, which is basically a lack of volume, but that's normalized by the price of the stock, because obviously you're going to get less volume as the price goes up. The breadth is not there. McClellan oscillator has been negative. The new highs and new lows index has barely been positive. We'll come back to this one here in a second. Let's see what's been updated so far. It was at 28, I believe. It's at 37 right now. Like, we're not getting above 100 like we did even in February. We're not even nearly as high as we were in August on this. So it's still, we're still not getting the breadth. And you saw with the 50-day, the number of stocks above the 50-day moving average are slightly above 250 and slightly above its moving average. But look at them, how much is above the 200. We're still below the moving average. Then when you look at how many are above the 20%, the 20-day line, we're below 50%. So all these other times that we've had these peaks, you've had plenty of stocks above their 20-day moving average. We don't even have 50% of the stocks currently above their 20-day moving average. That's how much weakness we have. And you can see all the way on these other peaks, we never, like right here when we dip below 50%, was after a decline. Like during the rally, we never had, all the way up to the peak, all the way up to the highest high, we never dropped below 50%. All the way up to this highest high, we never dropped below 50%. All the way up here, we dropped to 50% on that decline, only to rally back up. So we're not, we got up here, but during the sideways action, we dropped hard below 50%, and we're still below it. And we're still a little bit above the moving average, but we're not above that 50% mark to where you feel strong about a trend. And of course, you add on to the 50 and 200-day averages as well, you can see why, again, breadth is still a problem. It is a major problem, and why, especially if we get some kind of knee-jerk reaction or to any kind of positive debt ceiling announcement, the lack of breadth would suggest that might, the odds of it being a knee-jerk fake-out type move are higher than even normal, because we just don't have the rest of the market participating beyond, again, that small subset of the markets in small areas, particularly this technology, communication services areas. You can see that here on the 12 grid as well. When we look at the 12 grid for this, it's right here. You can see that XLK and XLC are still very, very strong. Well, at 3-month highs, 15% gains, 14% gains. XLY looks pretty strong too, but when you look at the scales, only up 3%. So it's the weakest out of the three in this category. But look at all the dark pink shading and red lines. Like, again, that's not bullish to have that much. And at best, XLI and XLF are flat. Everything else has got dark pink shading and a red line. XLP really dropping hard. We're not getting the breadth. And that's when you're bullish and you're breaking through a certain level, everything's going to be bullish. You don't typically start to get rotation until you're in the mature stages of that. Rotation in terms of like some things going up and others going down, right? Generally, the rotation would be some things are going up more and other things are going up less, but everything's going up. And obviously, you can see not everything is going up right now. All right, now let's take a look at our trade idea of the day. So we'll pull up the chart here and we'll take a look at eBay. eBay was a trade that we done in Market Outlook previously that just expired in May for a neutral trade. I still like the neutral setup that it actually has. You can see it did break out on earnings while we were in that trade, but it ended up finishing right in the middle, right where we were when we got into it originally. And we're right back in that same spot that we were. The intermediate line is down, though your short-term sentiment's rising. You're not very far below the moving average. So a lot of really neutral indicators as I go through all of these. You'll see it's still bearish, but it's pretty flat. The long-term trend. The 3 green arrow chart, you can see we have 3 red arrows, though we're barely red, and the momentum on the MACD already is starting to move higher on the histogram. You're right around that point of control, which is the 1 year, the only really volume node that we've had this entire year. When you look at some of these other oscillators, they're also at neutral levels as well, both below 25 on the DMI. The ADX is easily below 20. The Ichimoku cloud is still not showing a trend at all right now. You can see slightly positive, which is actually better, and holding support at the bottom of the cloud, so we're not really through the cloud in either direction. Looking at the RSI and the CCI, the RSI and the CCI, you can see they're both in neutral levels here too, between the hundreds and between 40 and 60. And then finally the Bollinger Bands are well inside the Keltner channel, with the low bandwidth that's falling again, and there's your bands inside the Keltner channels with your red dots, and slight negative momentum that's not very strong, as the positive wasn't really strong to begin with either. So really, really neutral patterns all across the board. And like I said, we've already been in the trade, a neutral trade for it before, and now we'll just do it again, right? Selling the 25 delta, buying the 2 strikes away, selling the 42 delta, buying 2 strikes away, or 42, which is a 25 delta on that side, buying 2 strikes away. That sets you up here. Full position size, since we're through the earnings for the stock. It won't have earnings before June expiration, and then a pretty decent reward, and then there's your break evens. So your break evens, I mean, obviously if you're going to be breaking out of either of these break evens, you're going to be trending, right? You're going to have a directional move at that point, at which point we might look at a directional trade. But as of right now, up 1.5% to be as flat as it is perfect for this type of strategy. All right, well, that does it for today. You've heard from me now, and I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join us at MarketScholars.com for free. Like us and follow us on Twitter and Facebook as well. Have a great rest of your Monday evening, everybody, and we'll see you all next time.